We've had lots of companies reporting earnings, several companies in the portfolio that we've highlighted on the channel before, and in my writing here on Seeking Alpha. It's a crazy time in markets, as I'm sure you're aware, with tariff-driven volatility, trade war-driven volatility being the dominant theme of this second quarter of 2025 so far. So next up on the list for us to cover today and review earnings that were released yesterday on April 23rd for the first quarter is Lam Research, ticker LRCX. This is a company that I've covered in 2 videos so far on the channel. I've made a research video about the stock itself, and I've also made a comparison video between Lam Research and Applied Materials, one of its peers in the semiconductor equipment manufacturing space. So they released earnings, and today I'm going to review the earnings on camera for the first time. I haven't looked at the earnings yet, and I'm going to assess if the outlook of the stock is different based on the earnings and also based on the outlook in the market today. As we know, the last 3 weeks since Liberation Day, the infamous Liberation Day, have thrown the world upside down and introduced a whole new level of risk and potential rewards in the market. And so I think Lam Research is a challenging stock in the current environment because you have, on the one hand, massive secular tailwinds brewing from artificial intelligence and robotics. That's something that I spoke to in the videos I've made about the company and how it's essentially been my top pick so far to get exposure to the AI industrial revolution from the time that I made the video. However, I do think that the trade war is really complicating the short-term outlook of the company. So this is the article that I wrote about it on Seeking Alpha. If you don't have Seeking Alpha Premium, I have an offer for my viewers to get a discount on a premium subscription to Seeking Alpha. That way you can read all of my articles, my in-depth analysis. Admittedly, it's a little bit more well put together in writing than it is here on camera because I don't have a script. I just flip through things in rapid order when I'm doing these things on camera. So my articles are a little more focused and present the information in an easier to digest format. The link will be in the description. But as I mentioned, and the thesis in the article here was that the long-term outlook here for semiconductors, particularly for Lam Research, is kind of a picks and shovels play on all these secular tailwinds that I expect to expand over time, that the phenomenal long-term outlook, very, very bright for the company. However, in the time since this article and since my initial videos have been published, the stock has woefully underperformed the market. Now, one thing about this stock, and I've highlighted this before, is that it's much more volatile than the market at large. And that should not be surprising. Semiconductor stocks are cyclical. Some are more cyclical than others. But semiconductors are a boom and bust industry, and they're correlated to industrial demand and consumer spending demand, depending on what they are and what the end markets are. So Lam Research is, of course, highly correlated to the industrial cycle, given that it creates the equipment that semiconductor manufacturers then use to actually create the chips. It's been very challenged because the semi-equipment market has been in somewhat of a down cycle, and you see that reflected here in the stock price. It peaked at an all-time high above $100 a share. This is post-split, split adjusted. At one point, it was over $1,000 a share before split, and it drew down 40%, and it was starting to recover pretty nicely, but then once people started to catch on to what President Trump was looking to do on February 19th, that's what started the current drawdown in the broader based market. So we see um, Lamb had really meaningfully outperformed leading up to the day of the peak there in late February. It had significantly outperformed the market by almost 20%, and in recent months has meaningfully underperformed. However, year to date it is still outperforming slightly, but I think it goes without saying here that this is a very volatile stock. It's in a volatile industry, and it's a high beta growth stock. So, high beta growth stocks are, of course, more volatile than the index. So, the trade war has really complicated things in the near term. And this video is going to be a little bit longer than the last couple earnings reviews that I've done, because I'm really going to try my best to discuss some of the risks that I'm seeing as it pertains to semiconductors in the current environment. But I think before we do that, I would like to review the earnings report. So I'm going to navigate to their website. Okay, so let's take a look at their presentation. Okay, so quarter ending at the end of March. And let's take a look. So as they report, strong execution, March quarter revenues, margins, earnings per share above guidance midpoints. So slightly outperforming the middle of the road case. Record foundry revenues, solid product momentum, and leading edge inflections, and record gross margin since the merger in 2012 with Novellus Systems, that is. Investments in operations contributing positively. They still see in 2025 WFE spending in the $100 billion range, which again is more of an industry-wide outlook there. So Lamb's expected outperformance, this is one thing that management has been outspoken about, is that they do expect to outperform this market. They expect to outperform, and the way they expand to do that is to expand faster than the growth here. Okay, they expect to gain share with new products and grow CSBG, which is defined as Customer Support Business Group, revenue faster than installed base. So one thing that we talked about before was that they have a service component, kind of like Otis Elevator that I talked about earlier today. Not only do they manufacture the machines that manufacture the semiconductors, but they also service them. So they're basically saying we expect this sticky revenue base to lead to margin expansion and grow that quicker than the installed base of the machines. So that is a huge driver of economic profits. And SAM is defined as served available market, by the way. Expand served available market faster than WFE. So these are a couple of their products here. They say incredible momentum, seeing increased adoption of the Altus Halo Mom, ultra fast plasma control enabling multiple wins in DRAM, and Striker Spark ALD, multiple key wins for spacer applications at leading edge foundry. ALD meaning atomic layer deposition, MO meaning molybdenum, 3D meaning three-dimensional, and DRAM, of course, meaning dynamic random access memory. This is just language, but let's take a look at this. So in the quarter ending March, 4.72 billion of revenue versus the prior quarter of 4.38. So that's a high single digit, mid single digit level of growth. So 6-7% top line growth quarter over quarter, very, very strong. And then we had earnings per share up to $1.04 versus 91 cents in the prior quarter. So 13 cents on 91 cents. That's pretty strong. That's like 15% growth. Here We have our breakdown of revenue by region. Again, the thing that we need to take a look at here is China is the largest region by revenue, almost a third of the revenue. Then Korea, then Taiwan. Okay, so again, the reason that that's significant, Korea, of course, we have companies like Samsung, the consumer electronics companies, the vehicle companies that are either manufacturing or purchasing the end semiconductor uses in Korea. You have Taiwan, that's where Taiwan Semiconductor is located, and others. So that's foundry based. And then Japan, to a lesser extent, 10% there. China, of course, is a big deal, but we see here about half of the revenue from foundry. I've discussed this kind of overarching theme of risk, trade war uncertainty, all of that. I think it's pretty easy to see that when we look at the revenue by region, why that is a concern that I have right now. We see here U.S. representing only 4% here of revenue, and then Europe being 3%. Okay, so we're highly exposed to Asia as an end market. They say here record foundry and Taiwan revenue dollars. Okay, customer support business group. Again, that's our sticky service based revenue. Okay, coming in at 1.68 billion versus 1.75 for the prior quarter and 1.4 for the prior year quarter. A slight dip quarter over quarter, but 280 million. That's 20% growth over the prior years. And then here we have our revenue numbers, our adjusted gross margin up 150 basis points, our adjusted operating income up 200 million. So that's mid-teens percent. Our operating margins up 210 basis points. And then here we have our earnings per share. And there was a modest amount of outstanding shares decreased quarter over quarter. Cash we see, and AR down, day sales outstanding 62 days, so they've tightened up on collections somewhat, but we have less current assets, slightly more inventories, and then slightly higher inventory turns. So while we're collecting, or our day sales outstanding have gone down, cash going down, and AR going down versus inventories going up. I don't want to read into those numbers too well, but you can imagine the trifecta of those three things happening at once to a massive scale. That would not be good, but I wouldn't read into that too much here. We see here that they actually repurchased way less shares from the prior quarter, and actually paid out slightly less in dividends. So our dividend per share was the same, but we decreased share count. So for the upcoming quarter, they expect to do 5 billion in revenue plus or minus 300 million. 5 billion on 4.7. That's a high mid to high single digit growth rate. Plus or minus, though, it could be flat or they could exceed that. So that, if they were to hit this, it would essentially be another quarter of comparable revenue growth to this quarter. Our non-GAAP gross margin, they're expecting roughly the same. Non-GAAP operating margin, roughly the same. And non-GAAP earnings per share of $1.20 plus or minus 10. So that would be pretty strong. Growth there. So I'm not really going to pour into that, because what I'm mainly curious about as a shareholder, and I think we also should talk about how the market has reacted very very well to these results. We had At one point, it had traded all the way down to $61 on the earnings report. There was a slight bump ahead of time, buying going into earnings, and we increased by about 5-6% on the news. And then again, today at market open, we increased another 6% over the day. So very, very strong market reaction to the news. The market definitely liked what they saw in the numbers. One thing that I do want to just jump right into is what they're saying about tariffs. Tariffs, again, this is management commentary, maybe a Q&A piece, but I think it's very important that we analyze the commentary here and draw a conclusion from it. So, speaking is Timothy Archer being president and CEO of the company. So, from an overall industry perspective, we continue to forecast calendar year spending of the industry at large in the $100 billion range. We recognize that the current tariff and global economic environment is dynamic, but thus far we have not seen any meaningful changes for our customers' plans. That's interesting. We're closely monitoring the situation alongside our customers and ecosystem partners. We believe that the agile manufacturing and supply chain capability that we have developed in recent years provides us with the flexibility to lessen the direct impact of tariffs. Near term, we're taking steps to lessen the direct impact of tariffs and closely monitoring for longer term indicators of demand changes. The news so much is, they're basically saying, hey, no tariff impacts yet. We're going to monitor that. We're expecting gross margin for the upcoming quarter of roughly in line with what we experienced last quarter. This guidance includes our current assessment of the direct impacts of tariffs on our business. So they're actually saying that they don't expect tariffs to impact their business meaningfully, at least in terms of gross margins. Let me wrap up. We're off to a strong start in 2025. We're executing well on our critical operational and financial objectives. While the tariff-related macro uncertainty is keeping the environment dynamic, customers are continuing to invest consistently with their planned technology roadmaps. Forgive me, Tim, if that's the incorrect pronunciation of your name, but Timothy at UBS asked a question on the call. Thanks a lot, Tim. You made a comment. I think you said taking steps to limit the impact of tariffs. Can you talk about that? I guess you do have a free trade zone in Fremont. And then when you make the tools in Malaysia, the country of origin is Malaysia. So you should be fine there too. But you did say taking steps to limit the impact. So can you kind of go into some details on that? And Mr. Archer, the CEO, says, well, I don't know that I can go into a lot of details on as far as the specific steps. But what I can say is that we've worked hard over the last several years to build a very flexible manufacturing and supply chain operation that's centered around our U.S. operations in Asia, as Doug said, close to our customers and close to the supply chain. And so when I say taking steps, it's no different than what we're always doing. We look at the environment, we look at the customers, and then we optimize that capability that we have that exists in many different places in the world to deliver our tools most efficiently and most effectively to our customers. And I think that that's a result. I mean, that flexibility is, again, part of the strategy we executed when we saw disruptions like COVID and other things over the past years to really broaden out the global capability of our supply chain manufacturing operations. And Douglas Bettinger added, and Tim, I just remind you, it's Doug. We've got factories all over the world, right? We've got factories in the United States, factories in Austria, factories in Malaysia, factories in Taiwan, factories in Korea. And we've been talking about this for a while. The fact that we have that broad footprint enabled us to have some level of flexibility. And I guess I just leave it there. Harlan Sir with JP Morgan asks, maybe to follow up on Tim's question. So on the reciprocal tariffs that were levied on many countries, including Malaysia and Taiwan, obviously there's a 90-day reprieve through early July. But let's assume that somehow this doesn't get resolved, or you still have some residual tariffs even post-resolution. Great question. Does Lam team have enough manufacturing capability in the U.S. to service your leading-edge customers and be aggressively building out plants here in the U.S.? I know before your manufacturing consolidation initiative, you did have manufacturing in Oregon and in California. I'm not sure how that footprint has changed as you brought on your Malaysia factory. So again, Mr. Archer says, Yeah, but go back to Doug's comment about our longstanding strategy of putting our capabilities close to our customers. And so you referred to this as we see customers expanding aggressively in the US. Obviously, that will occur over a period of time in which we've already shown an ability to be agile within our manufacturing and supply chain, like I mentioned, where we move things to regions where we can meet our customers' needs more effectively. Think that if we continue to see more investment in the US, we still have operations, significant manufacturing capabilities and footprint in the US. And obviously, as each region grows, we reassess what local manufacturing we need to support that capability. And Douglas Bettinger again adds that we can't just instantaneously change things, but given enough lead time, once you know what the rules are, that's a subtle dig at the administration, I think. You can adjust certain things with a period of time. So just think about that. It might take a little bit of time depending on what shows up, but we have an ability to be flexible. So I think we're just going to continue looking at this. Harlan continues, says, I assume near term you have spares and subsystem inventory that were in place before tariffs. Just wondering if there are some basic materials that you or your subsystem partner source from China, which could quickly be a cost headwind for the team, maybe beyond the June quarter, either on spare parts or subsystem side of the business, could impact product costs if the tariff headwinds remain. Excellent questions, Harlan. You're asking what we all want to know. Listen, Harlan, I don't want to get into everything like what do you have where in which country. We've got a global supply chain footprint. We've got a global manufacturing footprint. We have an ability to respond to different things depending on what the rules are and how they change. I guess I'll just leave it at that. Atif Malik, again, excuse me if I am not pronouncing your name correctly, but uh, the analyst from Citi has what appears to be a pretty interesting and coded question. Um, the first question being on WFE. They ask, one of your North American customers is going through some major restructuring. We get asked from investors if you guys have baked in kind of a net neutral spending scenario for the logic customers in an event that customer tends to abandon the foundry plans or changes direction. Mr. Bettinger again says, I guess what I would say, I won't talk about one specific customer. I mean, generally speaking, you guys hear about something, you've known about it well in advance of whatever you're hearing, right? Because they got to tell us what they're doing. We're going to have people there. We're going to have spare parts there to do installation and whatnot. So yes, to the best of our ability, we've contemplated everything we've seen in the totality of the market. So follow-up question. So I'm just curious, is that comment based on the fact that the lead times are super long for your tools or your customer kind of pipeline has not changed much from what you were seeing 90 days ago? So if you could just expand on what is that comment based on? And again, Mr. Bettinger responds by saying it's based on plans that we've known these customers have had in place well in advance of even 90 days ago, right? If I think back late to last year, the outlook we had for the current quarter that we just guided has not changed. Frankly, the whole year hasn't changed. Sticking to it. I don't want to communicate, hey, could something change? Of course, anything can change, but we're not seeing anything change in the environment. We're staying very diligent on contemplating, okay, tariffs are out there. Might that have a macro impact? Might the economy get softer? Of course, we're aware of those things. Could that negatively impact things at some point? It could. We're not seeing anything else. What Archer is saying here is that they're so foundational to the semiconductor investment process that the sales that they're making now and the service units that they're bringing online now, he says here that we're engaging customers at the leading edge, where I think strategically they feel they don't have as much of a choice, but to continue to invest in those areas to make sure they're as competitive as they can be. So that's interesting because he's basically saying, hey, our products are a necessity for these big build outs that are occurring for our customers, the things that are already announced, those are going to be seen to fruition. Um, and I don't really know what to make of that, but that is interesting. So Blaine Curtis is the analyst who asked this initial question. Blaine Curtis from Jefferies asks, then for my second, I just want to ask Doug's, in terms of the guidance on the gross margin, is there any impact from tariffs? I know we have 90-day reprieve. For Bettinger, he must be the CFO. He says, yes, Blaine, there absolutely is an impact, but it's contemplating based on everything we know and everything we understand. It's contemplated in that guidance. I don't want to communicate there's not an impact. There's absolutely an impact. Okay, but is there any way to quantify it, or you don't want to go there? I'm not going to go there. Okay. So there's a lot to So my thoughts so far, the numbers in the earnings report look very good. the management commentary sounds very good, but I'm still skeptical here. I'm being overly skeptical about this, mainly because when I see reports about, so here, U.S. President Donald Trump's proposed tariffs on semiconductors. That's behind the reciprocal tariffs um, originally set forth on executive order currently include a minimum 10% tariffs on all imports of foreign origin goods, subject to certain exclusions. One such exclusion is for the semiconductor product category. What they talked about in that transcript is they're talking about how they've made an effort to more localize their manufacturing to where the customer is located. And they talked about the Malaysia facility. We see here that the 14 primary locations, none of those locations are in China. We have Malaysia, India, Taiwan, Korea, Korea, and then North America, and then one facility in Austria. So this is going to be very much overly simplified, but common sense to me is pointing to you have this localized supply chain where we're manufacturing things close to the point of sale. So, in other words, we're manufacturing semiconductors in Malaysia and Korea and India that were then selling into the China market. We're manufacturing the equipment for semiconductor manufacturing. So these tariffs here have no impact, little to no impact on Lam because they're not manufacturing stuff in Malaysia that they're then importing to America to sell to Taiwan Semiconductor in Arizona, right? They're manufacturing that here, right? So what I'm concerned about is more the fallout of the trade war and restrictions that China in particular might create on American, things that are ultimately manufactured by American companies like Lam Research that then gets sold into the Chinese market. Now, the fact that they're selling 31% of their revenue is into China is indicative of the value of their products and their usefulness, right? So maybe it stands to be seen that the equipment manufacturing that Lam is doing and the products that they create are going to be purchased by China. They need those products and they're going to continue to purchase them regardless of any trade friction. But in an environment where China is being very retaliatory with their trade restrictions and whatnot, I do have some level of concern as to the type of retaliation that they can implement on the things that are ultimately getting sold into that market. So again, while it remains to be seen based on commentary and the numbers, I over the long run am starting to become somewhat concerned about our relations with China from a business perspective. You know, the Trump talked about there was a leak about potentially, I don't know if it was a leak or his actual commentary, but there was a story about how the White House was considering delisting Chinese ADRs from our stock markets, right? So those types of actions are the types of things that create more risk around these numbers here. Hopefully, what I'm saying is translating. Where when we're investigating things here, I think there's plenty of reasons to be cautiously optimistic about this company in light of the trade war. I'm concerned about the geopolitical relationship we have with China right now, and I really hope that there's some sort of resolution that allows all parties to prosper in a fair and balanced environment, in as much so as it can be. But I think it goes without saying that if we had some sort of let's just assume in the worst, most dire case scenario that the United States and China are actually in a kinetic war. In a kinetic war in the Asia Pacific theater, boots on the ground, naval ships, that type of thing. Companies like Lam Research are going to be severely impacted by that potentially because you have, again, if Lam Research is trying to sell its products to any of these nations and they need to sail across the Pacific to do that, to get their products to Taiwan, to get their products to Korea, not to mention that China might take over Taiwan, right? If that's happening, we have other problems. But you see the sensitivity that I'm seeing of the company to a full blown wartime worst case scenario. I'm not trying to be a doomer or say that that's what I expect to happen, but I think we just need to be aware of if the trade war with China is to severely deteriorate and turn into something much worse than what it is now. Um, I do expect lots of volatility in the shares of this company, right? Because it's these types of companies that I would think China would retaliate unless their products are so necessary to the domestic industry that there might be some sort of exception there or whatnot. But hopefully you understand what I'm saying. I've been cautious about the company ever since the trade war broke out. And looking at these numbers, I will say I do feel a little bit better about what I'm seeing. I do feel a little eased by what the management is saying. I feel like the numbers look very good. But I would expect this ticker, this company, to trade with a lot of volatility on trade war news. Um, I expect it to trade much higher on any sort of deal or resolution that's announced. I expect it to trade much lower on a steepening of tensions. Okay, despite the good numbers. So I think right now the thesis is intact, and we've got excellent looking business results and excellent looking numbers, and so far so good. The business is not impacted by tariffs right now. There's no first order effects of the tariffs that are impacting the business. That makes me feel better. However, I do, if your objective is to build a wartime portfolio because you're expecting a Pacific theater war between China and America, then perhaps you would avoid the stock. I'm not saying that that's what I think is going to happen. I'm just, I'm really, really, really trying to be as skeptical as possible about the risks. Let's just take a brief look at the chart. And I think, again, what we're seeing here, whether you draw it out to this time frame or this time frame, the long-term trend continues to be intact. And the valuation that it has now, at least in terms of price per share from a technical perspective, is quite attractive because we're hanging out close to the support of this long-term trend. And you see how volatile the shares can get from 30 a share up to 110 and back and forth. So I think from a technical perspective, where the shares are now is uh, very attractive. Um, but I don't think we're out of the weeds yet here. I really don't, in terms, and this is just me being a cautious, defensive minded investor. I really don't have a lot of companies like this in my portfolio that are more volatile. So that's just my style. If it's not your style, it's not your style, and that's fine. But I do think that where we're at now is an attractive entry point, and I would think that the stock would do quite well on a pair back of trade tension. The stock has proven to be sensitive to tariff news, despite the fact that management is saying that that's not really in focus. So I think the entry point here is compelling if you want to speculate on the tariffs not happening, right? Um, that's not really how I want to speculate with my portfolio right now. I think that it's certainly attractive, but I will say this: I'm not doubling down here. I am underwater on my shares. I believe my cost basis is $74 a share in mid low 70s, and the stock traded all the way down to 58 before it caught a bid. Um, One thing that I have done actually is I have entered a stop loss for exactly half of my shares, again at $58 a share, because basically what I'm expecting is if there is an all out full blown escalation of the trade war, I do want to trim the position somewhat before reassessing entering again. So for all those reasons, I really am impressed by the numbers. I think the growth story is intact. I think that there's many compelling reasons why somebody might enter a position here or double down on their position. However, I will not be doing that because I'm really trying to protect downside here when it comes to my portfolio in general. So I've entered the stop loss, but I'm still holding. So I am downgrading the stock to hold for now because I really want to see things play out a little bit. However, we did approach recently, we approached a level of pretty insane risk reward. You see here how the stock basically bounced off of this 60 a share level here, that it's kind of held, not going back to here, but held uh, through the tail end of 2023, and it kind of bounced off of that. So I do see why this might be a compelling entry point if you are very optimistic about the trade war and tariffs. I'm really trying to not drink the Kool-Aid too much on that and wait and see. I think in the current environment, there's many exposures and equities that are uh, much less exposed to geopolitical risk and have better expected returns than this. However, I don't see a reason to sell at the current price, and I'm very cautiously optimistic that shares will recover. But so far, this has been a loser for me, and I definitely want to wait and see. I have a relatively small position in the company, um, and continue to do so, and that's another reason why, because I do have long term optimism in the name, that's another reason why I'm considering, or why I have the stop loss set to trim half of the shares if we get back down to the $58 level, because I don't necessarily want to just wipe out my entire position in it. So I continue to monitor the position. But I do still think that there's compelling reasons why somebody might want to invest here if you have a certain view about the market and certain view about how things are going to go, and if you're optimistic. And I don't necessarily share those views. I might change my view in my writing there as well. Hopefully, it makes sense what I'm saying. The difference between the two things are. If you're curious to see what I do with my writing, then again consider getting a premium subscription if you don't have one, and following me so you can stay up to date on that research. But um, I'm definitely just riding it out, holding shares here. I don't see a reason to sell at the current level. I don't see a reason to buy at the current level for my risk tolerance and portfolio objectives. But I'm definitely encouraged by the results, and you know think that the business has really phenomenal growth prospects. I would just hope to see a little bit more geographical diversification here. Um, and I think again the business will probably be fine if there was to be this highly disruptive event that were to drastically shift the revenue by region. It just would take some time for things to shift around, and it would temporarily impair the stock price if that were to happen. So I want to manage my risk on the name. But um, anyways, that's going to conclude our video today. Hopefully, you've found what I'm saying useful and informative for your own portfolio. Again, it's not financial advice; it's just my opinion. Um, Please do your own diligence, and let me know what you think. Comment below. like the video, engage with me. I'd love to hear from you. I appreciate all of my viewers. We're almost at 300 subscribers. We're really coming up in the world here, but certainly an interesting stock, and certainly a interesting time to be watching the name. I'm going to continue to monitor the name, um, and out of all of the positions that I have, this is the one that I am most actively, monitoring for downside risk. So hopefully you found this instructive to your own goals, and you've enjoyed watching me ramble on and saying in some cases the same things 5 times in a row. Thank you for watching, and I'm now going to take a look at RSG earnings, which just dropped a few hours ago. So thank you for watching, and have a good rest of your day.